Hello, folks. This is Brandon Chapman with you. It's another Monday video for TheoTrade. It is October 6th, 2025, and the S&P is edging out another small update at 0.4%. Now, you take it as a whole, you say, well, yeah, you get those small updates every single day for the last 7 days, like we've seen here. It amounts to a fair amount. I mean, if I were to draw a line off the close to its current level right now, that's about a 2% move in the last 8 bars or 8 trading days, 11 calendar days. And so, again, it adds up over time. Now, as we look at today's performance, you look over to the right or the left here, you'll notice that the S&P is up 0.4, but gold is up nearly 2% today. And if we look at over the past week, and I'll just sort by this right here, gold is the second best performing asset when you compare it against the 12 other sectors or 11 other sectors and the S&P 500, with only XLV outperforming at 6%, but up 3.37. That's topped technology. And if we look at the last 6 weeks, gold is topped in the last 6 weeks, and the last 12 weeks has outperformed the market and every other sector in this 6 and 12 week period. So what's causing gold to go up so much? Well, generally speaking, gold goes up as the dollar goes down. And we look at this parabolic move we've seen in gold here. It began back on August 22nd. That was Powell's statement coming from Jackson Hole. That's the close in the market just there. So what did Powell say? We're talking rate cuts. The job market not doing so hot, more rate cuts, right? So we're pricing in the idea of rate cuts, a weaker dollar, helping to spur on all this movement we're seeing in gold as a result of the dollar declining. And that has certainly helped lift the markets generally and help keep them positive, even if the real value in the market's actually dropping in the midst of this. But what do we see from gold today? You know, frequently when I ask people, I say, hey, what's on your bingo card for day? You know, what are you walking in the day with? What symbols are you looking at? And it's funny. It's like, you know, I'll point out a stock that had significant option activity or an ETF. And frequently they say, well, I didn't see that one. Right. And there's these big trades that are going on just beneath the surface that most people never actually see. And this is something that, again, it's been something I'm trying to help people with. And I've designed a tool around which it's called the Ghost Prints Surveillance Console. And you'll notice something in gold today. Yeah, there's a couple of put prints in here at the ask, but this one right here, the Oct 17, 2025, 370 calls, 292,000 contracts, and we've scaled up here to about 317. Did you see that? Did this impact anything you've done today with regards to gold? I'm sure many of you are looking at gold and saying, oh yeah, gold's gone up today. It's up nearly 2%. Yes. But did you see the trade that was going on just beneath the surface on GLD that may give you some major indications about where gold may be heading and the current sentiment on gold or GLD specifically? And that's where you talk to people and say they have no idea, right? They had no idea that this went on today. And it doesn't help that Thinkorswim is actually missing lots and lots of data frequently. And I'll come in here. It was there earlier today, and then we looked at it a little bit ago. It's gone. Right? 17 Oct, you see the 355s in here. You don't see the 370s. But if you look at the option chain and you come here to 17 October, you'll see that there is, let me scroll down here to get it in view, 317,000 contracts. You didn't see that over 290,000 of which traded in one trade, right? And so we have these big, massive prints, and even a software program that's designed to pick up on this is missing the data. Had it earlier, and now it's gone. And you'll notice a big print down here, 114,000 contracts, but it's less than the open interest. So what do we take away from this? Well, they sold in part, they sold the 355 calls, and they bought the 370 calls, all in one trade. As a result, there are 3 major takeaways from this. Number 1, the reality that this is a roll, that they're selling one strike price that's deep in the money, close to an 80 delta, and at the same time, they're buying a 370 strike price. This roll means that in part, they might be taking profit here, that they're lowering their delta from the 79 to 34, meaning that this option's worth what? It's worth about $11. This one's worth about $250, $280. They're taking a significant chunk of profits out of this trade. Now, at the same time, they might be buying 3 times as many out here. Well, 3 times as many still does not get you to $11. So the first point is that this is a profit-taking move in gold, right? Specifically in GLD, at a point when gold is very, very extended and we're up nearly 2% today. So point number one, this is a profit-taking move. However, at the same time, they're leaving profits on the table, right? They're leaving almost half of the value in the 355s that they sold here, right? Or a little over half of the value in these calls out here at 370. It still maintains a bullish posture, right? So when I look at this, I say this is a bullish trade. That's point number two. While it's profit taking, it is a point to say, look, yes, they're leaving half of the value of this option on the table if we're basically buying almost 3 times the number of 370 calls as they're selling at the 355. So 3 times about 275. Again, we're a little bit over half of the price of the 355. So they're probably risk out, but they still have a significant amount of their profits still on the table because they bought more contracts out here. And the fact that this is a ratio, it's not like they sold the 355 and bought an equal number of contracts at the 370. There is still skin in the game at 370. And an expectation that likely they expect gold to go north of 370. So again, the roll itself and the fact that they scaled up the number of contracts is maintaining a bullish posture, despite the fact they are taking some profits likely in this trade. They're taking something off the table, at least in terms of risk. 370 is now what? It's an easy price to target at this point. And this is point number 3. The 370 is the target. Now you can say, well, 370 is not far out of the money from its current level. It's only $5 on a $365 stock. Yes, it is. However, how do you trade something like this? How do you trade it? Well, when you look at options and pricing, and specifically on gold, for example, if you want to keep it this week, notice something about the implied volatility. I got the implied volatility column on the left here. Let's get around to the at the money strike price. So we have strikes every single dollar. We got a 370 target price. And notice here, 19.26. Basically, this entire curve is flat. If I came out here around a 40 delta for the next 11 days, that puts me at about 368. I'm buying 19.26% implied volatility. And if I were to construct a spread selling the 370, it's 19.33. So the reality is that if I were to buy this vertical deep and wide, 1 month, 2 strike vertical, try this again. It's costing me about 71 cents. Is that a cheap spread? Not exactly. Is it an expensive spread? No. It's priced pretty fairly, if not with a slight edge, because I'm buying the lower vol and selling the higher vol. And if I can get a move to 370 and even maybe a little above it, I could easily close this out. Even if I get maybe 369.5, I could probably close that out for about a 70% gain. So if I go 0.71 times 1.7, that means it's got to be trading for about $1.20. Well, if we get to 370 up here or close to it, we could easily close that out for $1.20 with skew in our favor. And so as a result, these are relatively cheap spreads that have a little bit of edge in them that play the upside. If you want to give yourself more time, yeah, it might push you a little bit further out of the money, but let's see, is the skew more pronounced? It's actually more pronounced as we got here, but we're talking $5 spreads. So let's scale it back a little bit here. Let's go back to 39 days. Can I get dollar increment strike prices here? Yes, I can. Do I get a little bit better skew? Not really, but slightly. The 40 delta push you out to 370. And now we get to $5 spreads. But if I look at the same 368, 370, the probabilities are a little bit better because we're going out further in time. It's going to cost me 83 cents. But can we get to 370 in the next 39 days and allow me to close this out, not for $1.20 or $1.21, but rather for about $1.40? Yeah, if you get to 370, you're probably going to be able to close that out for $1.40 pretty easily. And you've got 39 days to do it. So while this is a relatively tight target, trading spreads and using the volatility term structure, it's called skew, by the way, where it's flat to slightly favorable. You could put on a relatively cheap spread for this month, October 17, or go out to November and get November 14 and pick it up for 80 cents and be able to close it out likely if we get to 370 up here, which is not much of a move. And so this is kind of the idea that, again, we're taking the takeaways, right? The roll itself is profit taking, right? They're taking some risk off the table. But the fact that they scaled up and sold and bought more of the 370s than they had sold of the lower strike price, again, we're still seeing they want to leave more risk on the table, which is bullish again, and a target price of 370. As a result, that's the strike price they're rolling to, refreshing that target price of 370 from the old strike price with which they had down here in the money now. So we scroll down at what strike price again? At the 355. They're just moving it up and they're raising the bar, raising the target for that strike price. And point number 4, not necessarily derived from this trade, but understanding option structure. It does allow you to create a relatively cheap spread either for 17 Oct or 14 November to play an out of the money spread targeting that 370 target price. Well, folks, again, this is kind of a big takeaway. And again, if you want to be able to spot these and other prints that are forming here, even stuff on SLV today that's popping up today. Again, notice here 23,000 contracts. That's the December 19 strike price at 47. Again, they're buying these calls today, 45.5 as well. If you want to be able to easily identify these prints, feel free to join me, Ghost Print Scanner, Ghost Print Console rather, Surveillance Console. We have a special presentation coming up on Wednesday. It's called a masterclass, and this will allow you to kind of jump on board and be able to learn how to identify squeezes in the market. We call them squeeze bar. They're called stocks that have high short interest and a high short ratio. I have my watch list in here, my Lotto 100. Learn how to scale up and why these options are cheap on these Lotto 100 stocks, and the ability to use the console for other types of prints as well. It'll allow you to quickly and easily get to the bottom line in the market, fill out your bingo card, and call it. Well, folks, we'll catch you back next week. Hopefully see you Wednesday, and feel free to join me on by calling our concierge team here at TheoTrade and join me on Wednesday. Anyway, folks, we'll catch you then. Thank you.